Here we go. Great. All right. Thank you, everyone, for joining us for today's session. The focus today is accounting for intangibles, and we have two presenters, and they'll both have 45 minutes each. So we're going to start out with Seokhyun, from George Washington University. So we'll just go right in, and as promised, I'll give you a 5-minute heads up when it's time to start wrapping up. So over to you, Seokhyun.
Thank you so much, Serena. Thank you so much for giving me the opportunity to present this work. This paper is co-authored with two professors, finance professors in Seoul Yonsei University, Professors Park and Lee. They provided the initial idea. Okay. Bill Baber and myself just merely added some accounting flavor to this paper. So let me see. So to capitalize or not to capitalize R&D is an important question that is very much alive according to Professor Penman's Abacus review paper. I'm shamelessly citing Professor Penman's review article. However, this paper is not about that big topic, but is about the information asymmetry and adverse selection problems that can be mitigated by allowing some R&D expenditures to be capitalized as R&D progresses. And obviously, this is permitted in IFRS IAS 38. We ask whether dividing the aggregate R&D into capitalized and expense components provides useful information on how companies finance their investments and how investors react to certain financing decisions, such as seasoned equity offerings and increase in cash balances. Our financing and information asymmetry focus differs from prior studies that focus on value relevance, principally asking whether the expensing or capitalizing one or the other leads to better performance measures and book values relevant to investors. We examine a relatively large as-reported data per Korean IFRS, whereas prior studies typically had to make certain assumptions about capitalization because in the United States, for example, R&D capitalization is not permitted except for certain software development costs. Our results are useful. We believe that for accounting policy setting, as they suggest that the capitalization versus expensing distinction conveys more information on R&D progress and reduces information asymmetry and thereby mitigate adverse selection problems associated with information asymmetry. So let's talk about R&D and financing. R&D is obviously critical for economic growth and innovation, but as we know, it carries high risk with uncertain outcomes. R&D also progresses in various stages for which insiders possess more information than outsiders. So that information asymmetry creates a lot of problems. So when information asymmetry occurs for corporate financing, it is a curse rather than a blessing for the insiders because outsiders tend to charge higher prices for lending and also underpriced equity issue stock prices when the stocks are issued because issuing stock carries information that the stock is overpriced by insiders. And as a result, there is a significant adverse selection and ex-post moral hazard issues. This adverse selection problem causes the R&D intensive companies to stay away from external funding as debt and equity. However, for R&D intensive companies, debt issues is especially more difficult because there is number one ex-post moral hazard issues. Okay, and what that is R&D ventures fails, then companies will have an even greater incentive to execute a much higher risk R&D so that the high payoff R&D can succeed, and that is detrimental to debt holders. Also, R&D asset is intangible and serves little collateral value. And as a result, for R&D intensive companies, internal cash is much more valuable and increase in internal cash balance is more valuable than other companies. So typical pecking order theory, typical firm for a typical firm for Myers and Modular framework is that internal cash is the cheapest source of financing, and debt is the next cheap source of financing because debt carries less information asymmetry and adverse selection problems, and debt can have a collateral and things like that. And the issuing debt does not carry a lot of information. In fact, it carries information that the debt is undervalued. So, and as a result, equity is the least attractive financing source. For R&D intensive companies, the order is a little bit reversed in that internal cash is still most valuable. However, equity is the next preferred, and the debt is the least preferred medium of financing. What that means is that R&D intensive companies will tend to hold a lot of cash, will tend to prefer equity issues whenever external financing is needed. And also, as a result, the debt to equity ratio or debt to total asset ratio, leverage ratio will be low for R&D intensive companies. And also the finance constraint, the typical finance constraint that is more severe for R&D intensive companies in the sense that internal cash is much more reliant. R&D investment is much more reliant on internal cash generations.
Hi, Sakin. We have one question and one comment so far.
Yes.
So on one of the earlier slides, Sudipta was commenting that some finance papers show that patents are used as collateral in bank loans. So I guess just a comment there.
I see. Okay. We do not in this paper consider patents, but I think that is something that we should consider later on. Yes.
Okay, and then we have a question from Albert. Albert, would you like to ask your question?
Yeah, sure. Thank you. I'm not entirely sure in the Korean context, but I'm just curious, just to kind of frame the later slides. Is stock-based compensation considered in this? Because I know R&D in the US, at least for GAAP, I think after a certain year, you were allowed to capitalize on the stock-based compensation equity piece for under an R&D expense as well. So just kind of curious if that's baked into this analysis here.
Well, it is. I cannot answer that question for the Korean companies because Korean companies may have different the rules for stock-based compensations. Okay, but stock-based compensation will affect income statement obviously, and then it is a form of equity financing effectively. So for the U.S. companies, and as a result, it will be eventually turned into equity financing for R&D intensive companies. So when a company has a lot of stock-based compensation, it will manifest as high equity and the lower debt to equity ratio as well. But I cannot say much about the Korean companies. Thank you. Our study is that already there are a lot of finance papers actually demonstrating that the high aggregate total R&D expenditures lead to high cash holdings, low financial leverage, and equity issues preferred rather than debt issuance. And R&D investment is much more sensitive to availability of internal cash flow. Our first job is to see whether these relationships hold for Korean companies as well as in United States companies, so that the result can be extended to US companies. Our next job is to see whether expense and capitalized component carries a different degree of information asymmetry, and as a result, different degree of adverse selection problems. So our job is to this association differ. That is demonstrated in finance differ between the unproven expensed R&D or some are proven capitalized R&D. We also add two other tests of examining whether high expensed R&D component, companies with a high expensed R&D component has a greater marginal value of cash. $1 in increase in cash balance is more valuable for those companies. And also whether companies with the high capitalized component of R&D suffers less SEO underpricing. Okay. As you know, SEO is underpriced. Okay. So with respect to Korean R&D accounting, since 2000, Korea required dividing the total R&D expenditures into R component, research, and the D development component, and expensing the R and capitalizing D. Okay. Effectively, Korean companies essentially are told that you you expense everything other than this D component, and you show the criteria, okay, things like that. So that criteria are effectively the same as IAS 38 IFRS criteria. And as a result, Korea's formal adoption of IFRS in 2011. In 2011, Korean companies all wholesale adopted IFRS, not only for R&D, but also for inventory revenue and for all accounting methods. So it did not alter the substance of the R&D accounting or the above criteria. And we demonstrate that by doing a DID, difference in difference analysis. And so the Korean data permits testing for the differential information content of expense R&D component versus capitalized R&D component using the as reported unadjusted data. And by the way, Korea is a very highly R&D intensive country, is number 2 in R&D intensity, R&D expenditures aggregate basis divided by GDP is number 2 in the world. And in terms of total R&D expenditures, the national basis is about $100 billion a year. That ranks number 5 in the world. So using the Hyundai Motor Company example, Hyundai Motor reports in 2016 R&D expenditures total about 2.3 trillion won in Korean currency, which is about 20 billion US dollars. Half of them were capitalized, 1.2 trillion won capitalized, and the other half was expensed, 1.2 trillion won. And that capitalized expenditures went into the balance, development cost, asset balance, and then there was amortization here, okay, and so on and so forth. So this is how Korean companies disclose these R&D expenditures, dividing into 2 components. So our methodologies is pretty simple, okay, in that we follow those of the existing finance research, okay, where why the dependent variable is cash, leverage, and equity issues, and so on, and is regressed on R&D intensity is the finance research. We merely divide this R&D into expense and capitalized component, along with other controls that is used in the finance studies. Obviously, there is no claim of causality, and we do a robustness check for the endogeneity following the GMM approach of Braun, Fazeri, and Peterson, who look at the R&D and corporate finance issues as well. We also do the DID. Yes.
Sorry, we have a question from Hayoung.
Yes.
Hi, Seok-Hyun. When I read this regression model, I was curious, why do you design it as a contemporaneous regression? So R&D from fiscal year T regressing on cash or equity issuance at the end of the same year, because your earlier stories seem to suggest that cash, internal cash or debt or equity issuance is the funding for R&D activities. So funding should come before your investment. But the regression you run here is actually the cash balance at the end of the year and also the R&D expense or capitalized amount at the end of the year or during that 12 months. I just want to know your motivation for running a contemporaneous regression. Yeah.
This is essentially an association study, and the R&D intensity is essentially sticky. It does not change a whole lot or way over the year. I guess we can try R&D as a lagged variable, but for the this cross-sectional and time series panel, it may or may not make a difference. But I think I take your point. Okay, so which one drives which one? Okay, is what you're asking.
Yeah, yeah.
So yeah, in general, in principle, financing decision comes first, and the investment decision comes first. So companies have to decide whether to execute R&D first and then get the financing. Okay. But that decision may come simultaneously as well. That's corporate finance 101. Is financing first, and then you find investment decision first, whether it's NP positive NPV, and then get the financing. Yeah. So yeah, I take your point. I think that we can try the lagging the R&D and the doing that as you suggested. Yes.
So a follow-up question is that all those variables are highly sticky, right? The serial correlation with the first leg usually is pretty high. Have you considered a change model or like a firm fixed effect somehow like capture the unexpected or component, not the lag or sticky component, persistent component? Yeah.
This has a firm fixed effect, and or in all regressions. So it is essentially mostly looking at the time series variations.
Okay.
But yeah. Okay, so well, let me see. So let me first summarize the results when R&D spending is decomposed into capitalized and expense components. Okay. In case that we don't run out of time, okay, which I think is not probably the case, cash holdings, okay, with respect to company cash holdings, expense but not capitalized R&D component varies positively with the cash holdings. In terms of leverage and equity issuance, okay, propensity to issue equity, expense but not capitalized R&D relates negatively with leverage. Okay, and expense components of R&D varies positively with. Sorry, I think this is not correct. It is varies negatively with leverage. Investment cash flow sensitivity, internal finance constraints are binding, more binding for expense components of R&D. Okay, and marginal value of cash is varies positively with expense component, but not capitalized R&D. Okay. And SCO announcement, seasoned equity offering announcement returns, okay, are more positive or less negative, okay, for capitalized R&D, okay, but not with the expense R&D. So that is the summary of the results, and all 6 to 7 relationship point to the same direction, that the expense R&D is the primary driver for causing all these financing decisions and information asymmetry and adverse selection problems. Okay. So the summary finding would be R&D to financing relationships found in US also hold for Korean companies, and the above relationships are mostly due to unproven R&D, not the capitalized R&D. All 6 tests point to the same direction, although the strength of result differs. And we like to say that mandating companies to capitalize certain R&D is informative and helps lower the information asymmetry and mitigates adverse selection problems with respect to financing. So let me talk about the data and summary statistics. Total R&D is about 1.7% of the total assets, and expense component is a large component, 1.2% of the assets, and the capitalized R&D is 0.5%. Okay. And obviously, expense versus capitalized distinction is about 5 to 2. Okay. $5 of expense component to capitalized component is about only 2. Obviously, capitalization requires a stringent criteria. Yeah, and yeah,
we have a few questions. I'll go with Sudipta.
Yes.
And then Aeon, you can ask your question.
Yes. How do you account for the amortization of the capitalized R&D? I mean,
yes, good question. Amortization, we do not account for it. We just merely divide the total R&D expenditures in a given year, and then how much was expensed versus how much was capitalized. Okay. So this expense, R&D expense, is not going to include amortization part of the R&D. Okay, amortized expense. Okay. It is just the spending, R&D spending, but how much among them will be expensed versus capitalized. That's how we distinguish them. Okay.
Aeon?
Yes.
Yes, so Seok-Heon, I think previously you mentioned that the aggregate R&D amount in Korea is actually sizable, it's at 100 billion. But if you go back to the earlier table, the one table before the summer, if you look at CAP, capitalized R&D, up to 75% of the observation have zero capitalized
Correct,
R&D.
correct. It is a
I just-
24% of the entire sample. Please note that this entire sample includes other companies that have zero R&Ds. Okay?
Yeah,
So in the United States, for example, 75% of the company will have zero R&D. Okay.
yeah.
In Korea, actually about 70% of the companies have R&D, positive R&D. Okay. What this is saying is that the for example, R&D, aggregate R&D, okay, P5, okay, this one is positive. Okay? You know, more than 50% of the companies have a positive R&D expenditures, regardless of whether it's capitalized or expensed. Okay? But the amount capitalized is smaller. Okay?
Yeah.
So yeah, this includes all zeros in the other companies. So that's why.
So one thing is that because most of your results, other than the season offering, you find that capitalized R&D amounts actually doesn't really matter. There's no significant correlations. I wonder that is because you have a bunch of zeros in capitalized R&D.
Yes,
so like
not much.
potentially you can conditional on having non-zero and then to see it's more like a fair horse race between expense and the capitalized amounts when the company has some capitalized R&D.
I see. So you are saying that you are thinking that why don't you restrict the sample to the companies that have positive R&D, positive aggregate R&D, and separate them into two, yes. We actually did that. Okay, and then it doesn't really change. But please wait a little bit because I'm going to explain that you are saying that capitalized R&D does not have any effect. Okay, and I will answer that question in a couple of slides later.
It's the season, the season issuance.
Yeah, please hold a little bit.
Thank you.
All right, so as you may see, okay, this is very highly correlated. Okay, expense, the aggregate R&D is highly correlated, capitalized R&D less correlated, and so on and so forth. So there is a obviously collinearity, high correlation is going to give you a high standard error. It's going to be a little bit difficult to distinguish between one from the other. But lo and behold, we were able to find differences. Okay? And so let me go to the this result first, the cash holdings. Does the expense and capitalized component differentially related to the cash holdings? So first, we find that the companies with high R&D intensity tend to hold high cash balances, okay, as in the US results, okay, so positive. And then if you separate this aggregate R&D into expensed and capitalized component, expense component dominates, okay, the capitalized components and is essentially driven by the expense component. You can reformulate. Yeah.
Sorry, we have a question from Shali.
Please wait a little bit, okay? So let me just finish this one.
Okay.
You can reformulate this regression, okay, into this one. Alternative and equivalent specification would be this. You run R&D and expense and component on a horse race between the two, despite the fact they are highly correlated, is the same regression actually, effectively. Okay. If you do that, then aggregate R&D loses significance and expensed R&D component pops out as strongly significant. Okay. Now you can also reformulate the same regression in another form. That is aggregate R&D and capitalized component of R&D. Okay. So what does this tell you? And this answers A. Young's question. Okay. Aggregate R&D is positively and strongly related with the size of the cash holdings. However, if you consider also the capitalized component, the larger the capitalized components of R&D, the smaller the cash holdings. Okay, so this one is significant. So I can say that capitalized component actually does matter, despite the fact it is only 25% of the sample. Okay, so all those regressions can be reformulated like this. Okay, however, there will be a different degree of multicollinearity problems because R&D and this one will be very highly correlated, and this one, okay, R&D and capitalized company will be less highly correlated, and so on and so forth. We chose this as to be a most simplistic, simple presentation, okay, like this. Okay, so do you have a, sorry, Charlotte, do you have a question?
Yes. I'm trying to think of the big picture question.
Sounds good.
What's
Yes.
the story, right? Yeah. So in my mind, I kind of view this as a story of operating risk versus financial risk. When firms, engage in R&D behaviors or R&D development, I view that as if firms engage in some sort of activity that increases the operating risk. So they're trying to balance it with reducing the financing risk. That's why the cash holding increases. So is the broad picture contribution that your paper have is basically shown that this standard actually works well in the sense that it shows us R&D that's expensed versus R&D that's capitalized. The R&D that's expensed carries more of the operating risk flavor type of thing, and it provides information to investors, and thus that we, in the US should also sort of have similar stand. Is that like the take I should take from away from your study?
First of all, good to see you, Shirley, and thank you for your comment. I think that's a great comment. I think your comment is well taken. I think actually what you're saying is you have our alternative explanation of what we find. Okay?
That's right.
I think that is
and
quite possible. I think that
Yeah.
that can be an interesting avenue of or extension of this research. Okay. However, it still is valid to say that well, distinguishing between expense component and capitalized component matters. Okay. Would you agree to that?
I agree. Oh,
Yes.
totally agree. It's
Yeah.
just like why it matters and how should we like inform the policy making, and yeah, I totally agree.
I see. So if under your kind of big picture theory, okay, this is not the information asymmetry or adverse selection issue, but it is the company counterbalancing operating risk versus financial risk. Yeah, that's an excellent question. I mean, that's an excellent point. Thank you.
We have another question from Joshua Ronan.
Yes.
Okay, just a little question. Do managers manage the distinction between capitalized and expensed, which would suggest that the results reflect the post-management of such distinction as opposed to the actual expensed and capitalized R&D?
Are you saying that there is a discretion in capitalizing versus expensing?
Wouldn't there be always such discretion?
Absolutely, I agree. I mean, absolutely, there will be discretion in the R&D capitalization. Yeah, I think company can actually capitalize less versus capitalize more. Okay. I mean, so I think that discretion you cannot actually dispel in any accounting policies. Okay, and I heard that there are a couple of Korean companies that are caught over capitalizing also.
No, I understand. But
yeah,
all I'm asking about is how does one interpret your results if the results are conditional on such management of the distinction between the two? And what kind of equilibrium we'd expect with respect to what results we expect given such management?
So I'm not sure how exactly I'm answer your question, because how would the company's management of those expenses translate different financing decisions? Because financing decision is a real decision, okay, and of expenses. There may be a third channel that are missing here, okay, where some expense management will lead to another kind of contractual changes and things like that can be considered. But at this point, I'm not unable to actually answer your question, which seems to be a very interesting question. Yes.
That's all right. Thank you.
Thank you. Okay. So the rest is to tendency to issue equity than debt in terms of financial leverage. Okay, the financial leverage is lower for high R&D intensive companies as in the United States, but I have to say this strength of the relationship is weaker than in the United States data. Okay, and obviously this is also coming from the expense component rather than the capitalized component. Equity issuance tendency to issue equity rather than debt is also verified here for the aggregate R&D, and that relationship is also driven mostly by the expense component of R&D. In terms of finance constraint, okay, is R&D more sensitive to internally generated cash flow? Okay. And the first column demonstrate that the same relationship that is found in the United States also hold for Korean data, and that is mostly coming from the expense component rather than the capitalized component. In terms of marginal value of cash, marginal for R&D intensive companies, $1 increase in cash balance is result in increase in stock returns, annual stock returns, get positive value, a very minor, kind of a little bit lower T statistic. However, yeah, that relationship also is driven mostly from the expense component of R&D, as in here. And seasoned equity announcement, offering announcements. Okay, I'm not sure why we have a positive relationship in the stock returns here. However, what that is that mostly that is coming from the capitalized component. In other words, companies with the higher capitalized component of R&D tend to suffer less SEO underpricing. Okay, if you recall in the summary statistics, I failed to mention that the average stock return, announcement return of SEO seasoned equity offering is a negative. Yes, yes. So that means companies having more of the positive capitalized R&D expenditures tend to suffer less. So this is the DID, difference in difference analysis around the full adoption of the IFRS in Korean companies. Okay. And not much activities here, post, and the expense component, post times capitalized component. This measures the incremental effect after the IFRS adoption. Okay. Only thing that we see here is essentially the in terms of the preference of equity issues, the higher capitalized expenditures, the company has higher capitalized expenditures, they tend to issue less equity, which is consistent with the previous finding. Okay. And also for the investment cash flow of finance, the restrictions, the result, finance constraint, okay, the higher the operating cash flow, okay, is also evident for more expenses, companies with the higher expense component of R&D, which is also consistent. So there is not much material change or differences between pre and post Korean IFRS adoption. However, if there is some change, then the change is toward supporting the previous results. So this is the GMM estimate, which uses about 30% less sample, and the results are kind of weaker than the existing result that I have reported, but most of them is about 5%, 1% significant level in the similar direction. So it is still pointing to the same direction, okay, the results. So the conclusions are follows. Okay, the established relationship between R&D intensity and financing choices also exists in Korea, and we can say that distinguishing between expense and capitalized R&D components conveys useful information to investors and outsiders, and that explains corporate financing decisions. The expense, not the capitalized component, is subject to more adverse selection problems. investors appear to utilize the accounting information to evaluate the corporate financing decisions in terms of marginal value of cash and SEO underpricing. All tests point to the same direction, which is comforting, although the strength of the results differs. I can venture to say that the all or none approach adopted by Internal Revenue Service, obviously to maximize the tax revenues, or US GAAP may be suboptimal from the standpoint of conveying useful information, as R&D expenditures contain varying degrees of outcome risk. And because I have a little bit more time, I would like to actually indulge myself into saying that why not let the firms capitalize certain R&D and advertising, is my personal bias, because capitalizing provides more information than expensing. Because if you capitalize some R&D or some advertising, it allows outsiders to undo the effects of capitalization. However, if you expense everything right away, you cannot go back to capitalization. Of course, you can make certain assumptions and the capitalization, depreciation assumption, things like that, but you cannot go that. At least on a pre-tax basis, capitalization provides more information because you can recreate income statement, at least on a pre-tax basis, on a full expensing basis, the other method. It's because of this capitalized R&D at the beginning, exist, and you capitalize certain R&D expenditures and you amortize some of them, and this will be the total R&D expenditures in addition to expense already there, will be ending balance of the capitalized R&D. If you want to eliminate this capitalization, all you need to do is subtract increase in the capitalized R&D balance from the income statement and add it to the expense items, and then you will get the income statement on a fully expensed component, fully expense based. However, you cannot go the other way around. So my question has been always, why not let the companies capitalize certain part of the advertising and depreciation, the research and development, so that the investors can have both information on hand and they can make the certain adjustment on themselves. Obviously, this will be possible as long as there is an articulation between income statement and balance sheet. I think this is an important part in the financial statement. And I typically complain about lack of articulation between income statement and balance sheet. And if there is an articulation, then we will have a much better adjustment to make in terms of any accounting policies and making appropriate adjustments. And a single focus of the balance sheet, a single focus of the income statement may not be a good idea as long as we create articulation between income statement and balance sheets.
Sukhyung, Sudipta, did you have a question that you wanted to ask or comment?
So in the US, a big component for some firms, at least, of R&D is IP R&D, sort of in mergers and acquisitions.
Mm-hmm.
I don't know what the equivalent is, whether Korea has that kind of accounting, but and whether it's changed or not over time. But I think you need to think about how mergers and the related R&D would flow through.
Yes, I actually do not know the answer to that. IPRD in Korea, how it is treated. So yes, we will take a look at it. IPRD and the patent issues that you raised. Which
We also had a design comment from Albert that piggybacks on Ayoung's comment earlier regarding the abundance of zeros. So just a suggestion to use a Poisson pseudo maximization likelihood estimation to help the data situation.
Okay. Yes. Good suggestion. Yes, do that. Thank you.
We still have about 5 minutes. I don't know if anyone else has any lingering questions. Steve?
Yeah, I got a weak internet connection here, so I may cut out. You talk a lot about moral hazard and adverse selection. I don't really see that coming up at all. These are very risky projects, okay?
Yes.
And you're saying that the managers know that they're not risky. I'm not sure about that. They're just risky projects, and so that affects your financing. When you get to development stage, then there's a judgment made. You're through phase 3. It's less risky, but I can't see the moral hazard and the adverse selection working in your data. Okay, so I wouldn't talk about that.
So adverse selection occurs because insiders tend to have a better information, and outsiders will overcharge in some sense, in many ways. For the lenders will overcharge, okay, and insiders would not agree to that overcharge. In other words, they can charge 8% interest on the loan because you are a risky company, okay, and I don't know what's going on. Okay? Insiders cannot divulge all the details about the operation to explain to them that this part is very successful and the other part is less successful, and we are confident that we are going to be successful. There is no communication mechanism between the two, and as a result, insiders will tend to not agree with the outsiders charging high price. Okay.
Yeah.
And
I understand
yes,
the story.
So that is,
I understand the story, but there's nothing in your data analysis that addresses that story. That insiders actually have more information. Just so.
If someone goes to work, it's like, they'll take something.
I think that assumption is taken given in many corporate finance the papers that a company have. Yeah, maybe I'm misunderstanding what your question is. Okay.
Well,
so,
in general, in certain contexts, yes, but here you're doing R&D. You
yes.
haven't got the product as yet. You don't know whether it's going to work. You're not even in phase 1. You know, it's just risk. Okay, you're as a scientist, you may be just as uncertain about as anyone else. So, but the point is, you're not bringing evidence of different information on the inside to drive it. But you don't need it. Okay, it's just that expense R&D is more risky than that's capitalized, and that's what's being conveyed. All I'm saying is just drop.
I see. Okay.
Yeah.
Yes.
And the other thing I might say is, coming back to the point when you went out of bounds at the end here, proposing what we should capitalize R&D. But you know, you can capitalize R&D. You can capitalize R&D as you have on the screen here, but then you've got to amortize it.
Yes.
You're doing R&D. You have no product yet. You have no revenues. You have no projected stream. How the hell do you get amortization? If you start amortizing it with a fluffy amortization, you're going to mess up the income statement. And your coordination of your income statement and balance sheet that you so desire is not going to be affected.
Right. So what I'm saying is merely that if you want to amortize, and I disagree, I can always get the income statement unamortized, uncapitalized basis. That's all I'm saying. So if you capitalize anything, I may disagree with you. Fine. Okay. I'm not actually beholden to your financial statement. I, as a reader, can actually disentangle the income statement toward the full expensing basis by just looking at how capitalized R&D balance increases. I just subtract from the income statement that amount, okay, and add it as an extra expense, okay, to get to the full expensing income statement. So that's all I'm saying. Okay?
But when you capitalize it, you've got to amortize it.
Correct. So that is the amortization component.
The point when you get to D, you actually maybe through phase 3, you have a product, you have a patent, maybe then you can amortize it. Okay, and that justifies the capitalization. So in my view, capitalization bears not what you put in the balance sheet, but your effect ultimately on the income statement. And bad amortizations are bad. You got R&D, it's only 95%, only 5% probability of being worked out. You're going to have an impairment next period, okay? Or you're going to have very bad amortizations. So you cannot talk about R&D in the balance sheet without the effect on the income statement. But actually, we're outside the bound of your talk.
Okay.
So we're at time. I'm so sorry to interject. Joshua, if you don't mind typing your comment so that Sokyeon could have that for later reference.
Sure.
Sokyeon,
Yes,
there
of
was a
course.
comment from Jim and Sudipta as well in the chat. So can we start to transition over to our
Thank you
second?
so much.
Thank you.
Thank you for all your comments.
Thank you. Thanks, Sokyeon.
You please stop sharing.
Look, sorry. Let me just actually get out of this. Okay.
Yep. Okay.
Hello there.
Hello.
Yeah, I'm not sure what's going on.
Let me just leave.
Yeah.
Sudipta is about to start his presentation.
Yeah, it's fine. Yeah. Okay.
Okay.
All right.
And so our second present, Sudipta, you're okay, or do you need us?
You talking to me? No.
No,
Can you
not you,
share
sorry.
your presentation?
Yeah, Sudipta, you're muted if you're saying anything. Okay. Okay, we're seeing.
Sorry. Yeah.
Yep, we're seeing your slides. So thank you so much, Sudipta, for presenting today. So over to you.
Okay, so this project is co-authored with Shinji Ma, former PhD student from Temple, and her colleague at NUS Business School in Singapore. We're looking at alternative data sources to estimate the value of teamwork for firms' human capital. Shinji is on the call, I see, so she will jump in when we need any specific details about what we've been doing. Okay, so by way of background, CEOs keep talking about how important the employees and teams are to firm performance. And we think of teamwork as basically the work done by a group acting together to contribute to the efficiency of the whole. And you can think about this going back to Adam Smith, the division of labor, specialization, and then coordination. And the idea is that countries with more specialists are more productive than countries that have lots of generalists. So that sort of goes back to Cicero, but Adam Smith that's the core proposition in The Wealth of Nations. Right? So how does teamwork affect or operate in firms' production? So we think that at least in modern firms, there's a lot of task specialization so that employees have certain things or roles they play where they do certain set of tasks. And then to get that task performed, sometimes they operate in teams where the different employees have different skills, and the combination of skills allows that work to be done, even when one particular individual may not have all the skills needed to get the task done. So you can think of writing a paper. Some people specialize in the empirical part, some people specialize in the writing, some people specialize in the framing, and so on. So we don't have a good empirical measure of teamwork, at least for US firms, because we don't have much disclosure, especially for large sample study. But even internally, we don't know what they're doing. And this is important because it affects how well they can manage their operations. Okay. So the research questions we're asking first, how much does teamwork matter for firm performance? Can we come up with at least a lower bound estimate? And then when does teamwork matter more? For the first question, we find that when we're trying to predict year ahead return on assets, then our estimate is that it adds 17.5% of variation. It explains 17.5% variation. And it matters more when firms have more complex tasks, so say high R&D firms, and when there's easier communication between the employees so they can actually collaborate. And we'll sort of talk about the different measures of doing that. So to dive into the first research question, firms are organized essentially as groups of individuals that have individual capabilities, but also synergies between them and synergies with other factors of production, capital, etc. They sort of contribute to firm goals by performing different roles that complement each other, and sort of at the root, the reason why firms exist is rooted in complementarity. Otherwise, you could do all your transactions in the market. So this is sort of like a Coasian notion of, why do firms exist? Why don't we do everything in markets? And so we think that the building blocks of employees' human capital are the skills that they each possess, but then it's the combinations of skills between and within employees that sort of generates the possibility for higher performance. So how do individual skills create human capital? If the skills we're looking at are the same across, say, a group of employees, they're all working on the production line, but they have similar skills and they can be interchanged, then the productivity is just additive in the sense that you can move them interchangeably and get the same output. But if they have different skills, then they might actually increase the marginal product of labor or each other's marginal product, in which case you get these interaction effects where the different skills increase the impact of a given skill. Okay? So how can we measure this human capital? I mean, there's very limited data provided in firms' financial statements. So right now we have disclosures on the number of employees and foreign versus domestic, although that's not fully populated. And we have the CEO pay ratio that was recently mandated, right? But the SEC has sort of spoken up and saying that investors are demanding more information about human capital in the firm because many people claim it's the most important asset of the firm, right? And if you don't have data on that, how can investors or lenders make good decisions? And the FASB has recently proposed that they want to have more disaggregated disclosures of the income statement. And specifically, they would like to provide more detailed employee compensation data. So this is a first step, or it's a further step in providing information about human capital at an annual level, of course. So how do we sort of come up with an estimate of skill-based human capital? So we're going to be looking at job postings by firms, and we're going to look at the skills that are specified in these job postings. And then we're going to sort of collect all of this information. And so we're going to be looking at skills that are specified in each posting. Then we're going to be looking at pairs of skills that an individual has and whether these different pairs of skills actually predict that future ROA. Then we're going to be looking at skill pairs across people in the same department, say in R&D. We're going to look at pairs of skills that haven't been absorbed at earlier levels at a division level, say a segment or a subsidiary. And then we're going to look at a further level up, skills that are not common between divisions, but are there in the firm. Okay? So we're trying to look at skills that might provide marginal or increase the marginal value at different levels of the firm. So we're thinking of the firm as a team of teams or a combination of departments, divisions, departments, and so on. So the way we're doing the counting is sort of think about two jobs that have 2 skills each. At an individual skill level, we have 1 count for A, 2 counts for B, and 1 count for C. At the individual levels, we have 1 pair of A and B and 1 pair of B and C. So those are the individual level skills. And then at the next level up, A and C are a department level pair because they aren't at the individual levels. They aren't found in the individuals, but these skills between people could potentially improve productivity. Okay? And then this goes on for division levels and firm levels. So there's these layers. Our second research question is, when does teamwork matter more? And we think it matters more for complex tasks, so tasks that are not very routine, like on the production line. Firms that have high Tobin skew, that is, it's sort of lots of ideas that are that are valuable, and so coming up with those ideas is a non-routine task. And a high-tech industry indicator that's also trying to get at the same idea. And then for communication, we're looking within the job postings for things like teamwork skills and so on. And we're also looking at whether the firms have few segments or operate in few areas, because then communication is easier because your access to other people in the firm is easier. So our main data is job posting data from Burning Glass Technologies. We restrict our sample to Compustat firms between 2010 and 2019 that have data for future ROA, because that's our main dependent variable. Okay? And so that gives us 15,000 firm year observations during this period. We also run some tests with occupation data from ONET, which is a data set that sort of provides a score on how routine the tasks are within an occupation. Okay? And this is going to be an alternative measure to our job posting based measures. We're going to use a machine learning approach. So we're going to be trying to predict next period ROA using the current period job posting based firm year teamwork measure. So these are the new skills that the company is bringing in, although they may be replacing people who are exiting. So we can't really tell. We don't have the information on the people who are exiting. And we're assuming that every job posting is filled with someone who has these qualifications that have been requested in the job posting. And the sort of machine language technique that we're using is the XGBoost algorithm. It's a powerful new algorithm that allows us to estimate these nonlinear or complex interactions between skills in a very fast or quick way, because it uses parallel processing and so on. Ayam.
Hi, Sujita. So when I read the paper, I'm still kind of confused about how do you measure the teamwork. So is it possible you go through a few slides back about...
So we're going to go forward and I'll sort of show you.
Oh, okay. Okay. Thank you.
Yeah. Okay. So if you want to go back here, is this what you have? This is the question you have?
Yeah, that's the question. Is I read about this part and then I look at the appendix, and then I'm still kind of not sure how do you capture firm year teamwork measure. Yeah.
So it's going to be essentially, if you see the department one. So if you think about now, if you had people in different divisions, right? So you think about 2 different segments. We would do the same exercise within each division and come up with these new pairs, right? So skills that are not absorbed already at an individual level or at a department level, but do occur in the division level. And then we're going to look at the firm level and look for all skill pairs that haven't been absorbed in the lower levels. And that's the firm level contribution to skills. teamwork skills.
So one follow-up question is that for department level teamwork, you do not consider individual skill pairs here. So
we're going to be looking at all of them. So the idea is that individuals in the team provide value with the skills they have, and the combination of the skills they have. But then these non-overlapping skills provide potential interaction effects that increase the value relative to having just common, identical employees, in which case you wouldn't get those interactions.
Okay, so that there's no analysis to separate individual skill pairs from department level.
So we do have that. So we're going to be looking at each layer separately. So we're going to look at all of these sets of skill pairs.
I see. Okay, thank you.
So we're using a sort of standard machine learning setup. So we have a training data set and a test data set at the top and bottom. The training set, both data sets are pre-processed to remove things that are not skills and so on. We use, identify those skills and then use this XGBoost to train in a test training sample the best predictor of future ROA. And then we take the next year's data with the same coefficients from the machine language, but with the new year's postings to come up with a prediction for ROA. And so we're trying to test out of sample. And we'll be using the R-squareds, out of sample R-squareds to compare various things. So this is sort of the idea. We're going to be using a rolling window scheme where we train the machine language over a 5-year period and then test the predictions from that machine language learning setup in the next year. And we have 5 of these rolling windows because we only have data from 2010. And so we're going to sort of show you the data for each year, but we can also look at compare averages across years. Okay, so we're first comparing our teamwork measure against existing measures in the literature. So Terry Shevlin has a paper and some other people. So one is just the number of employees. How well does the number of employees predict future ROA? And the other is a measure of employee turnover. So it turns out that employee turnover, the green line, explains very little, but number of employees does explain a good bit. So that's the orange line. But if you sort of look at the combination of those two, it's not much better than just having the orange line alone. So it's only in 1 year in 2019 that you can see a gap. But otherwise, the red line and orange line almost overlap. So the green line is not providing incremental explanatory power. Our measure is the blue line, and you can see that it's above the orange line in every year and seems to be above the red line in most years. We sort of also do sort of an incremental predictive ability. So if we combine the log employees and the teamwork, how much can we boost the R-squared from just teamwork? And from a number of employees, which is sort of the best in the previous literature. And you can see that we have an increase of over 50% in terms of predictive ability, comparing the green line to the orange line. So the orange line is sort of the best that the current literature has, and the green line, combining them, adds a lot of explanatory power. Okay. So here's Hyung's thing. So we look at the incremental explanatory power of each layer of the skills that we discussed or described earlier. So we look at just the list of all the skills, right? That explains 3.77% of the future ROA. If we look at the skill pairs within individuals, that explains 5.5%. So the first two together is about 9%. Then we look at the skill pairs that are not overlapped within individuals. So these are skill pairs that can be accessed at the department level if communication is possible, and if this skill pair is useful, presumably for more complex tasks. So the department level, the division level, and the firm level together add up to about 6%. Okay? So while a lot of productivity is coming from individual skills, that's because you can work on your own for a lot of things. Sort of getting access to other people adds another 6% or 2/3 of what you can earn as an individual or you can produce as an individual. Serena.
Just a point of clarification. So what are some of the examples of the skills that you guys are classifying?
So that's in the sort of bottom part of this
Is that
slide.
what the predictor? Is that the predictor
Yeah.
list that you have there?
Yep. And I think the appendix has a lot more of these, but for right now, this is straight out of table 4. And so some of these skills have a lot of predictive ability. Also, these are sort of the top 10, I think, that we've got.
Do you also incorporate like some sort of rank or level, or is it just any job posting that's in? So if
Look at any job posting. So I mean, obviously there are different skills needed for different jobs, but we haven't really sort of thought about the level of the employee and whether that would make a difference. We've just sort of at this point treated all employees as equal. But you're right, there may be some benefit to looking at the employee level. Or
I guess just thinking about the translating the impact to ROA, I can't imagine every job directly impacts ROA. Some things are just, you know, cost function, and I guess it translates in that way. But yeah, okay. But I think this is very.
I mean, if you think about the number of employees, right? I mean, say like a large company is 10,000 employees. If you just take the average, each employee can at max have 0.01 when you sort of average. And then if some are more, others have to be less and so on. So yeah, you get that point. But we are looking at the number of skills, not the number of employees. So that can be large.
Right. Albert?
Hey, yeah, thank you. I think I have a similar question along kind of what Serena's questioning was. I kind of curious, like, have you considered, given that you have this machinery, you have the data, have you considered like a mental model where maybe too big of a team actually hurts the efficiency or effectiveness? I'm guessing at a certain point, the skills start overlapping. But if your maybe team size is only like 4 or 5 people, I'm guessing that we'll see a stronger effect out of that. So it's more of a, I don't know if you've already done it, but it's also more of a suggestion in terms of a cross-sectional test you could perform.
So we haven't done it because I mean the machine language, machine learning program just optimizes over everything. So it's sort of agnostic as to how to pick the data. But we can sort of identify by adding these skill pairs or so on, what's the incremental contribution of each of these levels. Now we haven't looked at, say, interactions, 3 skills, for example, or 4 skill combinations. We just limited ourselves to pairs. But in theory, at least, a triplet or a quadruplet of skills could add incremental, productive ability too. So we view this as sort of very much of a lower bound estimation process. Yue?
Yue?
Oh, hi. I have a question that is in line with Serena's question. So I'm also thinking how this teamwork can be translated into the ROA. So one possibility I'm thinking is it possible that the measure is actually capturing the expansion of the firm's business line or the adoption of the new techniques of the firm. So that's taking accounting industry as an example. If the Big Four takes the first step and integrate business analytics or data analytics as the must-have skills for their new hires, then probably they will be translated into a superior ROA in their upcoming years compared to the non-adopting accounting firms.
So that's probably true, but I think they're competing in different segments. So, so the Big Four cannot really do audits of smaller firms at a cost-effective price, right? They have a lot of fixed costs. So their model works really well for large firms. and that's why they match to large firms. And then smaller firms have smaller auditors because they can be more cost effective. So in that sense, there's a matching thing going on in the background. And so the skills that firms invest in or desire is a function of their business model and their customers and all of that. So I think that in principle, if the customers are homogeneous, then your argument would make sense. But to the extent that the customers are not homogeneous and companies specialize in different segments of the market, then the argument is less obvious. I mean, it's still worth exploring. I'm not denying that. I'm just saying it's not obvious what to expect. Okay. But to return to your main question, I think that's a great idea about how it might happen. And so we probably need to talk a little bit about how this might evolve over time, for example.
Yeah, sure. So, or another example, probably firms that are producing the software, and at some point they want to bring it to the cloud business, so they need to hire people with this cloud ability. But in a sense, the customer that they are serving do not change, like in this case. So yeah, I think your explanation was convincing. So maybe you can also further look into maybe the characteristics of those firms that have the very high increase in their teamwork measure.
But we can certainly look at sort of new skills over time. So we can sort of look at the job postings and try to identify skills in, say, 2017 that were not posted in 2015 by any company, or some set of skills that are increasing in frequency, and try to see whether that makes a difference. So that sort of gets towards where you're going with cloud skills or, agile software development, or all these things, lean manufacturing, all of these things are different technologies that firms use. So I think there's things we can do along those lines. So, and I think it would be interesting to explore those.
Thank you.
Eric?
Hey, Sudipta. So just broadly looking at the data that you use to get the individual skills, do you have a sense for sort of, is that close to like the population of skills for a given firm? So for example, like if you went to see the job postings they have, is that going to be representative of all the skills they have within the firm? Or is it really just a subset of potentially some of the skills they're looking for at the current moment?
So we get all the job postings and we aggregate across all the job postings to create all these measures. And we have, where the job is located, so we can identify the department or the division and so on. So, we can sort of say that this job is in this MSA, and if there are other jobs in this MSA, they probably belong to the same division.
Okay, gotcha. And then I guess because I'm trying to think through, for example, let's say that like one MSA is hiring an accountant, but there wasn't a posting for like a finance person. But if they have a finance person already that's been there for 10 years, is that going to be missed by the data that you're using?
Yes.
Is there a way to go back, like just assume like go back 10 years and say like we've looked at all the job postings in this area and we assume that if they haven't hired again, that person's still there?
So our data is like 10 years, so we don't have a lot of room to do that. I mean, ideally, we'd like to know what is the stock of skills, and then this is sort of getting at the flow, the incoming, but not the outgoing, the people are departing either. So it's sort of like the R&D accounting that I was showing us, right? The capitalized and the amortization. So the inflow and outflow, we're just picking up the inflow. So presumably these are the skills that would add most to ROA, given where the firm is. But that's all we can sort of say.
I wonder if there's maybe like a setting you could look at where it's just more likely that this is more representative of all the skills they have, like maybe new firms or something like that. At least for me, it'd be interesting to see how this performs in a setting where the data is probably a little bit more representative of what you want. And I think that'd be nice to show that in that group, it actually gets much more predictive.
Certainly we could try that. At some level, large firms are going to have that finance job open in some other division, department. So, so doing the averages is not so bad, but at the higher level interactions, we're certainly missing a lot of stuff.
Yeah.
Right. So again, it's just a function of the data we have. It's not, in principle, we would like to do a lot more, but given the data we have, we're trying to do the most we can, given that limitation, right?
Yeah. Thanks.
Steve?
Yeah, under our accounting for return on assets, if we're investing in human capital, developing these teams and so on, it gets expense immediately. So I wonder whether your 1 year ahead ROA is what you want to look at, particularly for complex tasks. You get your team together, it's a complex, it may not show up for a long time. In fact, it may reduce your ROA the next period, because those expensings are going through without the benefit of what you get out of it. Here, it seems like instantaneously you get the benefit without the consideration of the expensing of R&D, of the human capital.
What is your alternative measure then? Let's start there.
Well, I don't know. That's not my problem. But
so we're using the measure that's been used in previous
careful,
papers. So, I mean, we didn't choose the ROA dependent variable.
No. That's not an excuse.
I agree, it's not an excuse. I'm just saying if you have a better measure, we'd be happy to use it. But
no, I'm saying you've got to qualify. You'd have to qualify. You're making an assumption about how the accounting for human capital works and affect our R&D, which is not how it works. So you've got to at least lay that out. Next year's R&D may, in fact, investing in human capital may, in fact, decrease next year's ROA.
That's fair enough. It depends on when the employee is hired, but even if it's halfway through the year on average, then they would still get 6 months worth of productivity, hopefully. But
yes, I understand it. But the question, you may be able to get situations where you can really sort this out. You should see the increase, and maybe a situation where you should see a decrease in ROA.
I think
another thing is, of course, is that employees extract the value they add. They form unions for joint production processes. So that's got to be considered too. It's not as if they're forming teams as a free thing, and employees can extract the productivity they bring.
They can extract more through unions than their productivity, but because the power of teams. I agree with that too. We haven't looked at unionized firms, but we can certainly sort of separate out unionized firms to get at that issue. So anyway, so we've sort of predict that this teamwork and this sort of ability to combine skills will be more valuable for firms with complex tasks. So we sort of use this routine task index as one measure. And then we look at firms with high Tobin skew and the high-tech dummy for basically software and R&D and that kind of thing, pharmaceuticals and so on. And the orange line is predicted to be higher. So that's where you should expect teamwork to matter more. And we find that essentially consistently it does so. We also look at sort of ease of communication or effectively ease of collaboration between different people in the firm. And so we look at different potential aspects of when that's likely. So when the job or the firm is described as relying on teamwork or desiring teamwork, and then looking at whether the postings are in the same MSA or very few MSAs or one segment firms versus multi-segment firms. The idea is in a one segment firm is probably easier to communicate with other people. So this is the one segment is line of business, the MSA is more like geographic segments. And again, consistent with our predictions, we're finding that the orange line is consistently above the blue line, with one exception in the lower right corner. If we do a sort of 2 by 2, so we just split them on the median of complexity and communication, it turns out that to get the benefits of teamwork, you need both highly complex tasks and high ease of communication. That is, if you have complex tasks but difficult communication, then you don't get much benefit. If you have lots of communication ability but not complex tasks, then you don't get much benefit from these combinations of skills. You get this combination of skills only when both conditions are met. That is, you have complex tasks and it's easy to communicate or collaborate between people.
Just a quick question. I think from all the graphs, there's a kind of dip in 2019. Is that because the ROA from 2020 somehow is very sensitive to complex firms who highlight teamwork? Is that why that there's a dip in the last pass, 2019?
So, I mean, I'm tempted to say COVID, but I don't know.
Oh, okay.
Honestly, we haven't looked, but I'm tempted to say. So then we sort of use this occupation level data from sort of the census type sources. So they divide, occupations into 5 levels of skill requirements. And so we sort of run the test using their classifications based on the occupations within each industry and so on. And we find that the highest benefit to our teamwork measure, again, comes in the top 2 zones, or the ones which require the most skills. And it has least benefit in zone 1, where the skills are most routine, but now based on a different data source. Coming back to Ayung's earlier question, is it individual skills or this sort of teamwork? So do individual skills and pairs of skills at the individual level matter? Or does complementarity matter? Or do both matter, right? So the idea is that specialization and sort of developing more individual skills likely adds to productivity. But this complementarity between individuals with different skills should also add to productivity. And so then the question is, does this matter differentially across complex tasks, right? So for routine tasks, you could see that individual skills should matter a lot, and complex skills, sort of high-level skills shouldn't matter as much. But does that relative mix change? So when we sort of do a 2-by-2 split now between specialized individuals and the complexity of tasks in the firm, we find that, again, it's only in the high combination that we find that specialization matters. So specialization matters a lot, or the number of skills at the individual level and the combinations of skills at the individual level matters a lot in firms with more complex environments. So higher R&D firms, High-Tobin skew, and the other one. But we also find that complementarity matters a lot more in these complex firms. So you need both specialization by individuals, but also complementarity between individuals in complex environments. So it's not just that having individuals with great skills is enough. What you want is basically, essentially the idea of comparative advantage, right? So you want people to specialize in different skills where they're good at, but then collaborate with people that have specialized in other skills to boost both their productivities. So both features add to productivity in firms with very complex jobs. So wrapping up, we contribute to the economics and management literatures by, I think, documenting something pretty basic about why firms exist, why employees invest in skills, and how firms can get the most out of employees' different skills by organizing teams. To the human capital literature by trying to create a new measure of human capital. This is not using firm disclosures, so using alternative sources, but that investors are probably mining themselves, because burning glass technologies doesn't exist only for academics. It's selling its data to investors and others, so they're probably coming up with their own measures of things that matter to them in terms of measuring human capital. And then we're using sort of a newish technique in machine learning, and so we're we believe, contributing to accounting research that is adopting new technologies. So thanks for your suggestions, pictures of Temple and NUS for those who are sort of wondering. And now,
thank you, thank you, Sudipta. Can I ask you, in terms of like industry construction of the data, are certain industries driving what you're looking at, or is that something that you guys kind of just did descriptively?
so we use Pharma French 30 industries. So we've got industries at that level of granularity. I mean, so that we don't have too few observations in each industry, but we have sort of represent industry diversity. And, you can see from a high-tech indicator, for example, that it's concentrated in a few industries. At least a big part of the effect is concentrated in a few industries that prior research, Francis, Ship, and Vincent, 94, classified as high-tech. But you can also think about high-Tobin skew, right? These are the firms with lots of intangibles, unbooked intangibles, high market book. So it's certainly the value is being created or being added in industries where idea generation is really important, or idea implementation is very important. And we're seeing that both in the individual skills that people are being hired for and the combinations of skills between people. And so, yeah, where tasks are more routine, industries where operations are simpler, or you're just using equipment that other people have produced and so it's become standardized, there I think you're getting less benefit from these skills than in these highly complex environments. But that's what you think about human capital in general, right? That the idea generation is really what makes human capital valuable. That's why you spend a lot of time brainstorming, right? Bringing together people with different ideas and in theory, that's the idea behind diversity as well. Right. So I am.
So for all those graphs, those are the results from the machine learning, right? Process. Did you include, for example, the previous years of ROA or like total number of employees? Because I think for simpler, think about a company with only like 50 employees, right? Doing a routine job. Last year's ROA probably is the best predictor compared to the complex, right? Measure.
So we haven't included lagged ROA, and that's because the literature we're comparing against also doesn't include lagged ROA.
Okay.
But yeah, I agree with you that sort of looking at a change in ROA and thinking about the new employees as sort of the change would be interesting as well. We just didn't find much bar when we tried to do it.
I think it's from like financial statement analysis point is that if you can give us a recipe, right? For this type of a firm, you use our measure. For 80% of a firm, just use total employees plus lag ROA, you'll be fine. R square will be 0.80 and your job is done. I think that is quite useful for us to know. Yeah.
I mean, we sort of showed you that there is sort of an incremental explanatory power of this over number of employees or, turnover. So that's the prior literature. You're showing you that there's a substantial incremental contribution, predictive ability. And then we are showing that most of this predictive ability is in these high-tech firms, where sort of the existing measures we know are not as good. That's why we had the first paper on intangibles and R&D, right? So we know that existing measures aren't very good at reporting it, at least this thing. So, so it's showing up where we expect it to show up, and then it's sort of validation in a sense that we're finding the effects where we think we should find it. So, right. And so in terms of the economic theory, there hasn't been a large sample test of the value of teamwork at all. So, I mean, this is the first step, I think, along that path. But we can certainly come up with better measures over time as we look at other disclosures, other information sources that investors may be using already that we are not aware of, right? Because data is not being made available for academics. Right? So they certainly have much better data mining powers and much better access to data than we have. So
one last request is, do you have the slide for the
oh yes,
next
I do.
event?
Sorry,
Derek
I do.
and I will present
Yes.
it. Thank you.
So in 2 weeks' time, we're going to have 2 papers on lease accounting. Ayung is going to present the second one, and Derek, who spoke up earlier, is going to present the first one. The registration details are provided here, but if you just go to the website, search for Accounting Design Project Columbia, it'll take you to a page where you can click on event listing, and then look at the current semesters and find the link for 2 weeks from now.
Thank you very much, Sudipta, and thank you everyone for joining and participating. Wishing you a great